My stocks to watch and avoid in February are Persimmon and easyJet. First up, I'm watching Persimmon, and here's why. Persimmon, the British housebuilder, has a compelling combination of market exposure, improving operational performance, and a share price that has rewarded investors since September of last year. Since then, the shares have risen 35% and by close to 15% over the past year. Several analysts have since upgraded their forecasts, and Persimmon's long-term upside target now sits at roughly 13% above current levels. There are three core drivers underpinning my bullish view. Firstly, housing demand is greater than supply, and with the UK government committing to build more homes, it provides a supportive backdrop for builders like Persimmon. Secondly, Persimmon has operational momentum from the past year after building more new homes and surpassing market expectations. And finally, strong operating margins and achievable profit targets paint a picture of a company with solid growth prospects. Looking beyond growth, Persimmon also offers an attractive dividend yield of around 4.25% for income-orientated investors. As always, there are risks involved, particularly if the UK economy or the housing market were to slow down. But with a positive share price performance, high demand for housing, and strong earnings potential, Persimmon looks to be heading in the right direction. Moving on to my stock to avoid, easyJet. While easyJet, the British low-cost airline, remains a household name, its share price performance has underperformed, and it has been trading sideways since 2023. That isn't bullish. On fundamentals, there are three key headwinds. Firstly, industry cost pressures remain high. Across the board, airlines face continued inflationary costs, which are squeezing margins. Then there is the exposure to geopolitical and economic risk. Conflict zones and currency swings can complicate capacity planning and forward bookings. And the US president's ongoing tariff threats aren't exactly reassuring travelers either. And finally, competition is fierce in the sector, with rivals such as Ryanair capturing market share. That said, easyJet did report profit growth and improved operations in recent trading. However, these results are not unique in the sector, and there is uncertainty about the company's ability to weather a downturn. So, faced with underwhelming price performance, growing structural costs, and competitive challenges, I would prefer to wait and see a fundamental shift in market positioning before deploying any capital to easyJet in February.